In this video, I'm going to tell you about something that can help you lower your taxes in retirement and make you feel even better about your generosity. I'm talking about Qualified Charitable Distributions, or QCDs, and we're starting right now. I'm Dan Lohmar, CFP professional with United Wealth Management, where we specialize in PR management and financial planning for pilots at United Airlines. And like many of you, my business partner, Alan Bewley, and I are both pilots for United. Welcome to another video. If you want to know how financial planning and PR management may help you, shoot me an email, dan@unitedwealthmanagement.com, and let me know what's on your mind. And hey, before we get started, just a reminder to subscribe and hit the bell icon so that you get notified when new videos come out. We've seen throughout my retirement tax planning videos the importance of managing tax-deferred accounts, because once you're over 70 and a half, you're forced to take out required minimum distributions, and that can be troublesome to your tax bill. It used to be that charitable donations could help you manage that bill when itemizing deductions, but with recent changes in the tax law, charitable donations need to be quite a bit larger to make the difference in your tax bill. What might make more sense today are Qualified Charitable Distributions, or QCDs. If you're charitably inclined, QCDs can help you manage your RMDs and lower your tax bill even with the higher standard deduction. Let's go over to the computer and I'll tell you what you need to know and how it works. So what do we need to know about Qualified Charitable Distributions and how do they work? That's what we're going to talk about. As always, this is for educational purposes only, so seek your advisor or tax professional regarding your situation. This should not be taken as tax, legal, or investment advice. So what's a QCD? Well, it's a tax-friendly transfer of money from an IRA directly to a charity, a 501c3 charity. And it helps satisfy RMDs for the year. And so they're not, and it's not reported as taxable income. So that helps us reduce our taxable income and fulfill our RMD for the year at the same time. And it's only for investors who have RMDs due, and you have to be over 70 and a half or older the day of the transfer. So even though your RMDs are due in the year that you turn 70 and a half, you still actually have to wait until you're actually older than 70 and a half to make the transfer. How is this different than just a regular deductible donation? Well, deductible donation is when you write a check to a charity, but a QCD is you're actually transferring money directly from your account, or the custodian writes the check in the name of the charity. So it's transferred. So that's the biggest difference right there. And then the question that always comes up is, aren't charitable donations tax deductible? So how much difference does it make? Yes, they are, but charitable donations are itemized deduction. So it's considered a below the line deduction. And so when we have a large standard deduction like we now have in the Tax Cuts and Jobs Act, it takes a much bigger charitable donation to get above the standard deduction threshold, which is, if you're married filing jointly, 24/4, and then of course if you're doing this, you're going to be over 70 and a half, so you have the additional $1,300 deduction for both of you. So it adds up to $27,000 standard deduction. So if your itemized deductions are not greater than your standard deduction, then writing a check to charity, even though it is technically deductible, it doesn't really have that much impact on your taxes. So are QCDs for everybody? Well, first of all, I'd say you have to be charitably inclined, because if it's not a big deal to you to give money to charity, then it doesn't really do you much good to give a big donation. Say if you give $10,000 to a charity just to save a certain amount in your taxes, that kind of defeats the purpose. So you have to be charitably inclined. This has to kind of work for you. But most commonly, people donate to churches, and so this would just be another way to make that donation. So how is it done? It's transferring money directly from the IRA to a charity. So or you can take possession of the check, but the check has to be written out to the charity itself, and it cannot be made out to you. So that's the big thing. Is you could call, if you had your IRA at Schwab, you could call Schwab and say, hey, I want to transfer money via a check, send it over to this charity. You could do it that way. But the biggest thing is that a check has to be written out to the charity. The biggest benefit is that it counts towards your required minimum distribution also, and it does not count as taxable income. And I'll show you an example how much difference that can make here in just a minute. And so with that being said, being that it's not taxable income, is it can lower your modified adjusted gross income below certain thresholds, like the net investment income threshold, Medicare surcharge threshold, or and also you're going to be doing this from your highest tax bracket. So it helps in regard to that also. How much can you do? You can do up to $100,000 per year per person for a married couple. And so a $200,000 total. And it can be more than your RMD. It's just an option for you, but it can't be more than $100,000 out of your IRA. So here's a hypothetical. So Captain Joe has an RMD due this year, $48,000, and he takes $38,000 as taxable income, or as income he's going to live off of, and he could fulfill his required minimum distribution by doing a $10,000 qualified charitable distribution. So the types of accounts you can do this with: IRAs, any type of an IRA, inherited IRA, SEP and simple IRAs, as long as you're not actively contributing to those. And an inherited IRA, you can still do it from an inherited IRA, but you still have to be over 70 and a half to do it. So you could have an inherited IRA and be taking distributions at a younger age, say 40, but you would not be qualified to do QCDs from an inherited IRA until you're 70 and a half. And then the thing that is not eligible is the 401k or the PRAP. So if you wanted to do QCDs, that would have to be rolled into an IRA. You can't do it from any type of a 401k. Which charities can you transfer these to? 501c3 charities. And so those are listed in that particular, that link will take you to the IRS website and pamphlet that shows you what are 501c3 charities, and you can put in the name of a charity and see that it qualifies. And then it cannot be a donor advised fund. You cannot donate it to a private foundation. And here's the other thing too, is if you're participating in, say, a golf outing sponsored by maybe a cancer awareness group, and it's a 501c3 charity, but you're going to participate and get a personal benefit out of it, doesn't qualify. So you cannot receive any personal benefit for the transfer. So how does it work as far as filing and reporting? So the custodian, only thing the custodian does is report your total distributions on your 1099-R. So they don't make any distinction whether it is a QCD or just income they receive. And there's no formal reporting. They don't send a report to the IRS that says, hey, Joe did a $10,000 direct transfer for a charity. They don't report any of that. So the biggest thing is you just have to have record of the donation to the charity, like a receipt. And then when you file your taxes, you just show, the 1099 will show what your distribution is, and then you adjust what the taxable amount of that distribution is. I would talk to your tax professional about doing this. And then again, your tax professional, they're not going to know until you talk to them about it. Again, there's no formal reporting of it. And then it may, state rules may vary. So I would check on that also. This is kind of what it looks like on a 1099-R when you're doing your taxes. Let's say Captain Joe had a gross distribution of $48,000. So that's the total amount that came out of his IRA for that year. He did a $10,000 QCD. As you see, it's not reported on here anywhere. But the reported taxable amount from that distribution is $38,000, so $10,000 less. And again, how is this different than a deductible donation? Well, let's just look at an example of Joe making a $10,000 donation to his church in two different ways. So the first thing he does is kind of his big picture. He's got an RMD due of $48,000. His standard deduction, his itemized deductions add up to $25,000, including a donation to his church. Let's just see how much difference it makes on the two different ways you can do this. The first way, he writes a check for $10,000. And this is kind of what his income looks like. His RMD due is the full thing is reported as taxable income. His adjusted gross income is $177,500. And of course, with that drives him above the $170,000 Medicare IRMA threshold. So he has two options. He can do itemized deductions for $25,000, which all of his itemized deductions add up to, or take the standard deduction of $27,000. Of course, he's going to take the bigger one. So his taxable income is $150,500, and then it results in his taxes shown there, and plus he pays an extra $12.98 in Medicare surcharges. Of course, that won't kick in if it's 2019 when he does this. That won't kick in until 2021. But again, it's going to result in almost $1,300 extra dollars in Medicare expenses. So his total right there is $26,125. If he does it the other way, and he does a qualified charitable distribution, this is what his income picture looks like. His RMD, the taxable portion is only $38,000, even though his total distribution is $48,000. The taxable part is $38,000. His adjusted gross income is $10,000 less. He's below the IRMA threshold when he does this. He again uses the standard deduction of $27,000. That's the same. His taxable income is $140,500. That's $10,000 less. His taxes go down. He does not owe IRMA thresholds. That's what his total tax picture looks like. And this is the difference the QCD saves. Saves him $2,200 in taxes. He does not pay $1,300 extra dollars in Medicare expenses. And so he saves a total of $34.98 by doing the qualified charitable distribution. Is a qualified charitable distribution always better than a charitable donation? No, it's not always better. It depends on the situation. So some charitable donations are much larger, and it might pay just to do the charitable donation. And then also the other thing is that QCDs, you do have to be 70.5 to do a qualified charitable distribution, and you do not have to be 70.5 to do a charitable donation. So that's why QCD isn't always better. And here's another case in point is you might have a highly appreciated stock, and donating the stock itself directly to charity might be a way that would get around two tax implications. It does two things. That avoids capital gains on the tax, and then it also counts as a deduction to charity if you're itemizing. So that can be pretty substantial. So here's an example of that, where you've got 500 shares of ABC Tech Company that you bought in 2010 for $10,000 total. Today it's worth $75,000. So it avoids two things. Avoid paying capital gains tax on $65,000, and then you'd also had an itemized deduction for a total of $75,000. And so as you can see, that would be an itemized deduction that would be pretty helpful. Any questions or comments about this, shoot me an email, dan@unitedwealthmanagement.com. And as always, this is for educational purposes only. And up next, to wrap up my video series on retirement tax planning, is going to be a video on rolling over. Should you keep your money in a 401k or roll it into an IRA? And so that you know when that video comes out, go ahead and subscribe and hit the bell icon so that you get notified. As you can see, qualified charitable distributions can help you lower your tax bill and help you feel even better about your generosity. Throughout my videos, I've talked about certain things that you can do in IRAs, but you cannot do in 401ks, like our PREP, and the other way around. These differences lead to the question, should you roll over the United Pilots PREP into an IRA when you retire? My next video will wrap up my retirement tax planning series by summarizing the advantages and disadvantages of rolling over a 401k into an IRA when you retire. That way you can make the decision that's best for you. And so that you know when that video comes out, go ahead and subscribe and hit the bell icon so that you get notified. If you're a United Pilot and you'd like to know more about financial planning and PREP management and how it may help you, shoot me an email, dan@unitedwealthmanagement.com, and let me know what's on your mind. Until next time, invest with a plan based on science and evidence. Everything else is just guessing.